Have you ever looked at a company that seems super successful and just wondered, what's really going on in there? Well, today we're going to put on our detective hats and uncover the true financial story that's hiding behind the numbers. It's a case just waiting to be cracked.
So you see a company with all the flashy products, a great reputation, they look amazing, right? But are they really as strong as they seem? Or are they, secretly scrambling to pay their bills? That's the exact mystery we're about to solve.
Every good detective needs a key piece of evidence to start with. And for us, that's a document called the balance sheet. This is where the most important clues about a company's financial health are hiding, pretty much in plain sight.
Okay, so our first step is to think of this balance sheet as a financial photo. It's a snapshot that captures exactly where the company stands at one single moment in time. This financial photo lays out three really important things. First, everything the company owns. We're talking cash, buildings, machines. Those are its assets. Second, everything it owes to other people, like bank loans. Those are its liabilities. And third, the money invested by its owners. That's its equity. Now, it's really important not to confuse this with an income statement. The best way to think about it is like this. The income statement is like a movie that shows you the company's profit or loss over a whole year. But the balance sheet, that's our photo. It shows you the company's financial position on one specific day.
All right, we've got our photo. Now it's time for the real detective work to begin. We need to zoom in and decode the clues inside the assets and liabilities, because, let me tell you, not all of them are created equal.
Let's start on the asset side. The absolute best thing you can see is cash. Why? Well, because you can use it immediately to pay bills. It's simple. A riskier asset, though, would be something like a huge warehouse full of products that haven't sold yet. Sure, it's worth something on paper, but all that money is stuck until somebody actually buys the stuff.
And you know what? The exact same logic applies to debt. Safer debt is a long-term loan, something the company can pay back slowly over many years. It gives them breathing room. But riskier debt, that's short-term. It has to be paid back fast, and that puts immediate pressure on all their cash.
So here's a massive red flag you should always look for. If a company's debts, its liabilities, are piling up faster than its valuable assets are growing, that company is heading straight for a danger zone. That is a critical clue.
But a single clue rarely solves the whole case. A good detective always looks for a pattern. So is the company getting stronger or is it getting weaker over time? To figure that out, we have to compare this year's financial photo to last year's. And here, this is what a strengthening company looks like. See that? From last year to this year, its assets are growing and its liabilities are shrinking. This kind of upward trend is just a fantastic sign of improving financial health. Of course, the opposite is just as revealing. A company is getting weaker if you see it constantly taking on new debt, not to grow or expand, but just to cover its basic day-to-day costs. That's a huge sign that the business just can't support itself.
This brings us to the climax of our investigation. After looking at the big picture and spotting the trends, it is time to examine the two most critical clues of all: cash and debt. And never, ever forget this. In business, cash is king, period. A company with a growing pile of cash is safe. It's got the resources to handle surprises, to pay its bills. But a company that is always running out of cash, that is a very dangerous path, and it can lead straight to bankruptcy.
And right here is one of the biggest dangers any company can face: the debt trap. It starts out simple enough. A company takes out loan A to run its business. But then it starts to struggle just to pay the interest on that loan. So what does it do? It takes out a brand new loan, loan B, for the sole purpose of paying the interest on loan A. And right there, the trap is set. That company is in very serious trouble.
So, you now have your complete detective toolkit. Just remember the steps. 1. Examine the balance sheet. That's your financial photo. 2. Decode the assets and liabilities. 3. See if the company is getting stronger by comparing photos over time. And 4. Check those ultimate clues. How much cash do they have, and are they caught in a debt trap?
So now you have the framework. You can look past all the fancy advertising and uncover the real story for yourself. You can read the financial clues. So, I guess the only question left is, which company will you investigate first?
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.